Okay, so in today's lesson, we're going to go through advanced trading concepts. So they're not really advanced, but it's just a bit more than the basics. First, we have the time based liquidity. It's basically predefined liquidity pools from prior sessions or days. And the good thing with this, it's always going to be here. Okay? These liquidity
Okay.
are always going to exist and they can help you to map out the day. You understand?
Yeah.
For example, we have the London highs and lows, the Asian highs and lows, and previous daily high and previous daily low. Here I've drawn out some examples. So here we have the Asia session, and here we have the London session. It's basically the range within these time frames, and I've shown the time frames in here. So I use from midnight to 6 a.m. for London, and from 6 p.m. to midnight for Asia. So right here we have the Asia high and London and Asia low, and here we have the London low and London high, and these are basically very good key levels you can always use.
Yeah.
They can act as like it's just like any other key level. They can act as magnets, pulling price towards them, or reaction zones where we might expect a consolidation or reversal. So, for example, in this example, we came down during New York to Asia low, and we gave a reaction to take longs. Okay, we manipulated down to them, and then we gave a entry confirmation up. So in here, you could have taken a long.
Yeah.
Now, for the second concept, we have inflection point or line of defense, depending on what you want to call them. It's a key level where price displaces through a high or low and leaves behind a fair value gap. And the key here, I said do not use this below the 15-minute time frame because I haven't really used them below the 15-minute time frame. This is mainly for the higher time frame. So yeah, if price later revisits that broken high, for example, in this example, we have a broken high, and we displaced through this high with many fair value gaps. When we come back to it, we can expect a reversal. Like we can expect this to hold as support, and if it was a bearish example, to be the opposite. So it can act as temporary support or temporary resistance. And this is not like traditional support and resistance. It's just they are used only once. So again, you displace above them, and then you come back to them, and then you want to see here, do we get an entry or not? And that's it. You don't want to use them more than this. And again, you mainly want to use them on the higher time frame.
Mm.
You got it so far?
Yeah.
Any questions?
No, not so far.
Okay, here we have opening range breakouts. I didn't draw an example because I'm gonna show you now. It's basically you use the first 5 or 15 minutes after New York Open to define a range. So the highs and lows on the first 5 minute candle and the highs and lows of the first 15-minute candle. And once we break plus displace with fair value gap outside this range, it can give clean setups on the 1 minute time frame in either direction. So you take it within the breakout. Do you understand?
Yeah.
This works well when aligned with high time frame bias and liquidity targets, and it can either be used as a confluence or a full trading strategy. So you can literally only use this for a full trading strategy, and you'd probably do pretty well. Do you understand?
Yeah.
I mainly use them as a confluence, though. I'm gonna show you now. So in here, you can see this, right?
Yeah.
Here we have the first 5 minutes. So I'm on the 5 minute chart. Here's the first 5 minute candle right here that printed in 9:30. Once you mark these levels out, you go into the 1 minute. Here's the 1 minute. So this is the first 5 minutes, the range, the highs and lows, and you wait. You wait for a break above this or below with a fair value gap. So right here, you would have gotten an entry long. Take an entry long, and then you put stops here or here. It's you can obviously try to test around with this, and then you can target a 1-to-1 or a 1-to-2, or you just target the next key level, which is liquidity. So for example, in here you would have liquidity here. You could have targeted here if you want to be conservative, or you could have just held beyond this key level. And now it's the same thing with for the 15 minute. So the first 15-minute candle after New York Open, it's right here. Okay, this is the first 15-minute candle, and this is the range. This is the high and this is the low. You do the same thing. You go into the 1 minute. Some people use the 5 minute for the 15-minute breakout, but for me, it doesn't really matter because I don't use this alone. I use other confluences. But if you want to use this as a full strategy, then you obviously have to back this and like try it many times before sticking to it.
Yeah.
And here you would have gotten the entry right here to take long. Same thing. You get it?
Yeah.
Okay, now for the most fun part, entry models. Now, do you know what this warning here says? Do you know what this means? All entry models should only be used at key levels with context. Do you know what this is?
That you should be looking at what happened prior to the entry model.
Kind of. But here's the thing. Many people they see entry models and they just enter or exit or place trades however they like as soon as they see an entry model. And that's basically pattern trading, which obviously doesn't work, and that's why many people are unprofitable. You only want to pay attention to entry models once you hit a key level.
Mm.
Do you understand? So now,
Yeah.
in this example here, you have a key level and then you get your entry model. You don't want to just place entries on random places. For example, here, you would have hundreds and thousands of fucking entry models right here, just within this leg, on
Yeah.
either side, either long or short. And obviously, you would lose a lot if you would take every single entry model in here. Only once a key level has been hit, that's when you look to enter and use the entry models. Do you understand?
Yeah.
Perfect. So now we're going to go through CISD, change in a state of delivery. This is one type of entry model. It's basically, if you can see here, do you see this right here? Before we hit the key level, or even after you hit it, you go down, you're going down, bearish candles, right?
Yeah.
You hit the key level and then you engulf this bearish candle. So you go back up and then you close above it with a bullish candle.
Mm.
So this was the most recent bearish movement. Before it, we had bullish candle and then bearish candles and then up to engulf this bearish movement.
Yeah.
Now this CISD is one of the options. It's like you can enter it in two different ways. So, for example, here's one way to enter. This is option one. Okay, this would give you higher win rate, but probably lower risk to reward. And the other one is option two, because right here you also have a bearish candle in here. If you can see it.
Yeah.
Do you see this bearish candle?
Yeah.
So as soon as you engulf it, you can take a long. But there's different ways to use this. Now here's the second option to use this. You have bearish candles here, bullish, and then one bearish candle. And then this bearish candle gets engulfed after you hit a key level. So this would be your entry confirmation, because you engulfed this and you got a CISD. But as I said, there are two options. Either you can use the bearish candle that start like the actual bearish move,
Yeah.
or within it, because you understand the difference here. Some people use this because this was an actual down movement, while this one is just a small pullback in an uptrend. If you know
Yeah.
what I mean.
Yeah.
Yeah, there are different ways to use this, as I said. Now for the second entry model, you have IFEGs, which are inverted fair value gaps. We've already gone through this a bit, but we're going to do it again for the viewers. An IFEG is basically when a fair value gap gets inverted. So now I took the same example because it's a very good example of both CISDs and IFEGs. You have fair value gaps going down. You hit the key level and then you go back up. And then you close above the fair value gap. So the bearish fair value gap gets engulfed by a bullish move.
Yeah.
So you have one IFEG here and one IFEG here. So there are many options on how you want to use this. Either you can enter on the first IFEG, or you wait for all of the IFEGs to get closed in the leg, or you can wait for the largest fair value gap in the leg to get inverted. You understand? Because maybe in this leg you would have 3 fair value gaps. Instead of waiting for all of them to close, you just wait for the largest one. And again, this is something you can play around with and try, see what works, what doesn't, etc. Now for the last entry model, we have fair value gap plus respect. And this is what basically this means. So you see this candle right here, we have a fair value gap. I just took any fair value gap for this example, but this mainly obviously should be used after a key level getting hit.
Yeah.
So we came down, we made a fair value gap, we came down into it, so we go back, retrace into it, and then you wait for the next candle to go up in the same direction of the fair value gap and close above it. So you wait for it to go down and then close above it. And that will be your entry.
And then you would take a long if the what's it called, if the fair value gap is bullish, you would go for a long. But if it was bearish, you'd go for a short.
What do you mean?
Like when you said you wait for the candle after it taps into the fair value gap to follow the direction of the candle that had the fair value gap.
Yes.
So like,
So for this example, let's say you hit the bullish key level. So that's obviously number one. That's the context. You have a bullish key level. That's been hit.
yeah,
So if it's a bullish key level, you wait for a bullish fair value gap, and then you
Yeah.
wait for a retracement, and then a continuation of that move after retracing.
yeah,
Because you're at a bullish key level, obviously. If you're at a bearish key level, it would be the opposite. You would wait for a
Okay.
bearish fair value gap and then a retracement in the respect of it.
yeah,
You understand?
yeah,
Now, for these entry models, you can combine them. So you can combine entry models and confirmations for higher probability. So for example, you can have a CISD plus an IFEG, or a CISD plus
Mm.
fair value gap, or a fair value gap plus IFEG, or a fair value gap plus IFEG plus respect. Do you understand?
yeah,
So you can
Yeah.
combine all of them if you would like to. You obviously, again, you have to test and see which one works best for you. For me, I use all of these different entry confirmations, but depending on the context, like, and yeah, there's not only one I stick to. Do you understand?
yeah,
But yeah, again, like the most important part of this is that they should only be used at key levels or with context.
yeah,
And here's the other thing about entry models that I didn't mention. Entry models can give you the bias and the direction and the context if you use them on a higher time frame. So for example, all of this can be used on the 4 hour. Okay? But it's not, you don't use it to enter, obviously. You use it for direction or for context or for bias.
yeah,
Do you understand? Because everything here,
Yeah.
like every single thing we go through, is can be used on all of the time frames.
Mm.
And now again, for the last final part, keeping it simple. So, more tools does not equal more profit. Same thing with information. More information does not equal more profit. You have to focus
Yeah.
on a few concepts and master them. And you have
Yeah.
to keep your trading as simple as possible so you can execute without hesitation. You should avoid
Yeah.
chasing advanced setups until you can execute the basics without hesitation.
Mm.
Because simplicity is what builds consistency. And if you try to make everything complex and like advanced, or you're chasing every single concept, then you would just it would just add noise to your trading, and you would never see consistency.
Yeah.
So this lesson and the lessons before we've had, you can combine, for example, a couple of the tools we've gone through, a couple of the confluences, and make your own strategy based on that.
Yeah.
And yeah, that was really it. No homework for today,
All right.
because you've already gone through them. So I don't see the point in giving you a homework. If this was just a video for the viewers.
Yeah.
Safe. Do you guys want to have access to the documents featured in the YouTube videos? Click the second link in the description to join our free Discord community, where you will get access to the documents plus a variety of resources to help you on your trading journey.